Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. With changeover and the weekly key reversal up seen 3 weeks ago, a point which I will deal with shortly, we had the beginnings of some significant changes affecting the market starting last week. We used to have two significant long-term patterns responsible for the market's actions. The first pattern was the breach and now broken late September 24 / late February 25 to end of June 2026 bearish shift pitchfork. Unless we see a significant move back below the upper time, which is currently at 14.28, then this pitchfork will be retired. The second long-term pattern has been breached and was on the verge of being broken, but prices did not stabilize over it, and I've returned back sort of just within it, though this is also a nervous move lower as well. It is the much larger, older and bigger bright red November 23 / September 24 bearish shift pitchfork, with today back below that bright red upper time, currently at 14.80, but only just. And now, up until the week before last, the bullish incentive was never quite strong enough to really test this upper time. But the changeover gap did that. What makes this a nervous pullback is how the market seems right now to be trying to stabilize on the flatlining gold long moving average, right now at 14.67, as well as the March 21 low at 14.66, and thus not filling in the gap left over 2 weeks ago. I was wondering if this might be a temporary situation, and be more concerned about the potential golden cross below between the green short medium moving average, currently at 14.43, and the mauve medium moving average, currently at 14.43 also. One positive case for the short-term bears out there, though a case that is soon undermined as it is a new bearish pattern, is the newly drawn dark blue mid-April to late June bullish Andrews pitchfork. The dark blue middle time currently at 15.53, providing the bearish, if progressively rising, downward pressure. And the recent times, it's a bullish pattern, but it's providing some bearish pressure at the moment. And it did that last week. There's another pattern to briefly mention before it is retired complete, and that is the late March to early May bearish shift pitchfork that complemented the other bearish pitchforks. Prices have moved up over the upper time, which is currently at 14.33, and is below the golden cross of moving averages. Now, should prices fill in the gap, what do we have to see below as support? Well, there is the 61.8% 21st century absolute Fibonacci line at 1383, which had been support earlier in the year in February and March, and again as recently as late May. But it does not seem to have worked well in April and now June, so please bear that in mind. Then there are the lows of April and June based on the 1320 to 1330 zone. These are the ones to watch, and this leads to some possible patterns, new patterns, that utilizes these lows as well as other action, though I am still having doubts about it despite setting up some topside targets for them. You see, I said last week, and it is a long quote, and I'm afraid it is a long quote. So I quote, a possible late March to date descending triangle utilizing the lows of April and last week as the base, and with the upper time acting as a proxy for the upper trend line. I added this time over the last few weeks when I said, and I quote, we're watching this idea very carefully, especially when it breaks higher. I also added later on the same commentary, and I quote, so watch carefully, especially if we do have a new pattern, such as a descending triangle pattern to contend with. Well, this idea of a descending triangle pattern has not gone away, rather the argument has strengthened, but this has not helped in discerning where the measuring points should be. Thus, I will lay out two possible descending triangle patterns here. The first is the smaller mid-April to end of June action, utilizing the same base for both descending triangles as the April 26 low at action at currently at 1322, with a dark blue broken upper time currently 14.33. as the downtrend. And the second pattern is the longer term end of March to end of June action, having a bright green upper tine. Well, it did have a bright green upper tine, it's no longer that. But that's currently at 1428. And that's as the upper downtrend. The first pattern has a primary target X in the 1600 area, with a secondary harder to reach X1 up in the 1682 area. Meanwhile, the second pattern has a primary target X2 up in the 1610 area, but secondary hard to reach target X3 up in the 1703 area. Even a cursory glance can show that whilst the primary targets are doable, the secondary targets look out of reach right now. This is where a new potentially third pattern comes in. I'm sorry about all this, but there is all this to go, not much more to go. And that's regard the whole late May today action as a possible quite large double bottom pattern that is still in construction. If, and it's a big if we get to the primary targets X and X2 and have consistent and consecutive closes over them, then we would have a double bottom pattern here, and quite a large one, for all the bullish implications that may have. However, first we have to get to the 1600 to 1610 area, and that is what we need to look for right now. And that's the end of the whole quote. I'm sorry it's a long one, but there's a lot to unpack there. But it still stands for now, as though prices have pulled back. That is all they have done, just a pullback, and not as yet killed off the idea of bullish patterns, but they have given the ideas some unnecessary stress at the moment. Ice Europe white sugar in London. Not quite the same in London sugar here as in New York sugar, though we do have some interesting bullish tendencies here as well, despite the pullback seen late last week and the start of this week. It all started 4 weeks ago when we had a weekly key reversal down, which was immediately countered the following week, so 3 weeks ago, by a larger and obviously more powerful weekly key reversal up. Now, I had warned about the weekly key reversal down not being as strong or as important as I first thought, because of the other patterns that were evident around the market at the time. 3 Fridays ago, prices broke up through the upper tine, currently at 439.10, of the late March to start of May bearish dark blue shift pitchfork. This was important as this upper tine shared, along with the bright green February to date uptrend, which is currently at 446.20, they shared a singular pattern, a sideways triangle pattern. Plus, this uptrend could also be part of a mid-April to late June ascending triangle, with the top being the approximate to the February 2020 high at 456.70. Thus, all this move higher left us for the sideways triangle a primary target at 473.70, a target already achieved, and a secondary hardest reach target X up in the 495.60 zone, which we came quite close to reaching last week. For the ascending triangle, we had a primary target X1 up in the 493.30 zone, again a target we came quite close to reaching last week, and a secondary hard to reach target X2 up in the 508 zone. There was one other bearish pattern that was breached, and possibly even now, even with the pullback, possibly still at issue, and that was the most important pattern here in the drive lower since early 2025. It is the bright pink September 24 to March 25 bearish shift pitchfork, which had been the showrunner for this market for about a year and a quarter, but which saw the upper pink tine, currently at 466.90, broken last week. Prices have been trying to stabilize over this pattern for the last 2 weeks, but today we are back below it, just under the February 2020 high at 456.70. Nevertheless, what do we have in the way topside that could affect the market's rise? Well, overhead we have the April 2017 high at 489.10, which capped prices last week, and then the extension to the old April to June 2021 head and shoulders neckline. It's quite an old one actually, that one, currently at 503.20. However, I would look to the congestion from early 2017 around the October 22 low at 514.5 to be potentially significant, and then the interesting bright red neckline extension to the end of May, end of August, reverse head and shoulders continuation pattern, a rarer head and shoulders pattern that is, and that's currently up at 526.90 as potentially being impactful. One important difference to note here when compared to New York sugar, there is no possibility of a reinforcing double bottom pattern here, I'm afraid. And that now brings me to what may be the key part of any decline, or should I say further decline. You see, if prices drop down below the bright green mid-February to date uptrend, which is currently at 446.20, and more importantly stabilise below it, then all these ideas of bullish higher prices, well, they will be off. This bright green uptrend is key to the two bullish triangle patterns, and if it fails, then they are off. So please pay special attention to it, and to the nearby August 21 low at 442.5, plus the medium moving average, currently at, where is that? That's at 449.5, and the flatlining long moving average, currently 431.40. If we do get down that far, then we will most definitely see targets topside retired by me, and be on the lookout for what would be the next pattern or patterns to emerge. Sugar white premium spread. Last week saw a relief from the recent constant pressuring higher market. Prices formed a weekly bearish engulfing pattern last week after the previous week's indecisive spinning top, the long tongue on the top side. The market opened the highest since April 2024, but then soon after dropped down through the important 2013 high at 152.75 and back below and within the dark blue upper trend line, currently 155.75, of the key recent pattern here, the dark blue February/March to date ascending expanding wedge pattern. It's currently 116.5 to 155.75. 2 weeks ago, I laid out some possibilities, not targets, but possibilities on the upside. And I quote, a primary possibility up in the 180 even zone, and a secondary hard to reach possibility, much harder to reach possibility, up in the 200 zone. The last time the market managed to get up to the 200 level was back in September 2022, and then it was only a fleeting movement, so caution. We should also clarify that the reason these are possibilities and not targets as yet is that we have only had one single close outside the bullish expanding wedge pattern, and thus, despite the strong move higher, we have not as yet confirmed the break upwards. Though I have to admit, I don't know what else the market could have done to try and confirm it right now. End of quote. Well, since then, we have had another close, but we are back within the ascending expanding wedge pattern and down to support from the June 2020 high at 134.25. And the green short medium moving average, currently at 132.75. But more importantly, the significant pair of 50% Fibonacci lines. From the July 19 to September 20 move and the August 21 to September 22 move at 128.75 and 131.75 respectively. So looking at it, one pullback pattern, even with the seeming follow-on lower move this week, does not make a bear market. But it may in the future temper or possibly even help with any potentials overhead. So continued caution. Now, I was thinking of ending it there last week, but then I noticed the possibility of another major pattern that could be in development, and that is a really big start of Q2 2024 to date, really big double bottom, one that can be seen as a rarer big W pattern. This pattern will depend on it for its construction on prices reaching and stabilizing over that important 180 level. So it's far from complete as yet, and indeed has some significant building work to do if it is to come about. But it is something to bear in mind for the future, just in case. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.